Welcome to the Explainer. Today, we're doing something really exciting. We are running a live valuation stress test on GeneDx, and we're going to apply the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham to a hyper-growth biotech stock. We're going to dive deep into the data, run the hard math, and see exactly what happens when old-school value investing collides head-on with cutting-edge genomic medicine.
Here's our roadmap for the analysis. We'll start with a company snapshot, then move through the Buffett, Lynch, and Graham lenses, follow that up with DCF and other valuation models, and wrap it all together with a final synthesis and verdict.
All right, Section 1, Company Snapshot. Let's establish the baseline reality.
So, GeneDx, ticker symbol WGS, is currently trading at $58.08 per share. And based on their roughly 29.3 million outstanding shares, that gives the company a market capitalization of right around $1.65 billion. What they actually do is fascinating. They're a leader in exome and genome testing, backed by what they call the GeneDx Infinity dataset. They are diagnosing rare diseases and partnering with heavyweights like Komodo Health to build these massive AI-powered healthcare intelligence maps. Plus, they just brought on Mark Gardner as president to help scale operations. So we're looking at a highly technical, high-impact business. But here's where it gets interesting. There's a stark contrast between their massive 34% volume growth in testing and their continued net losses, which creates this immediate, palpable tension for value investors. In Q1 of 2026, they pulled in $102.3 million in revenue, which is a solid 17% jump year over year. But they still posted a GAAP net loss of $63.3 million. This push and pull is exactly why we're stress testing the stock today.
Moving on to Section 2. Let's view this through our first framework, the Buffett lens, seeking the economic moat.
Now, you know Warren Buffett absolutely loves an economic moat, and GeneDx arguably has a massive one. They possess the world's largest rare disease genomic dataset to power their AI, including a repository of 2.5 million genetic tests and 1 million exomes and genomes. In the world of AI, data is destiny, right? That proprietary dataset gives them an undeniable moat against any new competitors trying to break into the rare disease diagnostic space.
So let's run Buffett's checklist. The crucial point here is that while they easily pass the moat and debt checks, thanks to an excellent balance sheet with about $172 million in cash, easily covering their $96 million in long-term debt, the lack of consistent earnings and negative return on equity immediately flags this. Buffett demands a history of predictable profitability, and GeneDx is projecting an $89.7 million net loss for 2026. Without those consistent earnings, Buffett's model basically breaks down. And what about owner earnings? Buffett values a stock based on the cash that can realistically be pulled out of the business without harming its operations. But with a projected 2026 free cash flow of negative $29.5 million, there just aren't any owner earnings. Since Buffett requires a margin of safety based on current cash generation, he would give this stock a hard pass at its current price.
Okay, Section 3. Let's switch gears to the Peter Lynch lens and categorize that growth.
Peter Lynch loves to categorize companies. And with their exome and genome volumes jumping over 30%, GeneDx undeniably falls into his fast grower bucket. Their updated guidance for 2026 anticipates volume growth of at least 30%, right alongside revenue growth of at least 20% in those segments. This is precisely the kind of rapid top-line expansion Lynch hunts for.
But here is the massive hurdle. The forward PE ratio sits at an astronomical 528. Lynch relies heavily on the PEG ratio, price to earnings divided by growth rate, and he generally wants a PEG of 1 or less. With an adjusted 2026 EPS forecast of just 11 cents, a 508x multiple completely shatters Lynch's reasonable price requirement, making the PEG ratio incredibly high, even with that 30% growth.
That said, they do pass a lot of Lynch's other checks. The balance sheet is rock solid, and institutional backing is there. Hedge funds like Eli Kasdan are loading up on shares. And that somewhat scary-looking $227,000 insider sale by CFO Kevin Feely, it turns out it was just a routine tax withholding, not a lack of faith in the company. So while Lynch would love the fundamentals and the institutional interest, that sky-high valuation means he'd likely rate this a hold, waiting patiently for some PE compression before buying in.
Section 4. Time to apply the strictest value framework of them all, the Benjamin Graham lens.
Graham's defensive investor checklist demands absolute stability above all else. Now, GeneDx is large enough at $1.65 billion, and they have a strong financial condition with current assets of $270 million, safely covering $87 million in current liabilities. However, it violently fails the earnings stability, dividend, and valuation multiple requirements. Graham wanted moderate price-to-earnings and price-to-book ratios, and frankly, GeneDx offers neither.
Let's actually play detective here and plug the numbers into Graham's intrinsic value formula. We can assume a book value per share of about $8.66, based on $254 million in equity divided by 29.3 million shares. But the negative GAAP EPS completely breaks the math. Even if we use their optimistic adjusted 11-cent EPS projection, the formula yields an intrinsic value of less than $5. Meaning, with zero margin of safety, Graham literally wouldn't touch this at $58 today.
Moving on to Section 5, DCF and other models. Let's project the future. Since historical value models kind of fall apart here, we have to pivot to modern, forward-looking math. Because the source data lacks long-term cash flows, we have to explicitly assume a 10% weighted average cost of capital, which is standard for biotech, and a pivot to profitability by 2028 just to run a baseline discounted cash flow model. We start with that 2026 projected negative free cash flow of $29.5 million and build it out assuming they capture a huge chunk of the rare disease market with a 3% terminal growth rate.
And when we run a sensitivity table on those assumptions, well, the current $58 price bakes in such unbelievably aggressive future cash flows that almost every traditional DCF scenario flags the stock as overvalued today. To justify a $1.65 billion valuation today using a 10% discount rate, GeneDx needs to generate hundreds of millions in sustainable free cash flow in the very near future. That is a massive expectation of execution.
But wait, looking at other valuation models tells a slightly different story. Yes, the PE multiple is sky high, but the price-to-sales ratio is actually really interesting. At a $1.65 billion market cap against roughly $478 million in projected 2026 revenue, the price-to-sales ratio is 3.45x. That actually looks somewhat undervalued when you compare it to a fast-growth biotech industry average, which often trades at 5 times sales or even higher. Finally, Section 6. Let's synthesize all of this for our final verdict.
When we put it all together in this summary matrix, you see a total clash of paradigms. Traditional value investors like Buffett and Graham say sell or pass because there's just no current margin of safety based on historical earnings. Growth models like Peter Lynch's suggest a cautious hold, basically waiting for the actual earnings to catch up to the stock price. Meanwhile, Wall Street analysts maintain a strong buy consensus with an average target of $78.44.
So, what's the blended reality? You are essentially buying into incredible 70% adjusted gross margins and a powerful, unmatched AI data moat. But you're paying a massive premium to do it, all while taking on significant cash burn risk. You are betting that management's guidance, hitting $540 to $555 million in revenue by 2026, is going to be executed flawlessly. Which leaves us with this final provocative thought. In the world of cutting-edge genomic medicine, where data and AI are completely reshaping how we diagnose disease, do the old rules of value investing even still apply? Or is the future simply worth the premium?